Imagine trusting someone with your entire financial future, only to realize that someone might soon be an algorithm. Across America, millions of people are quietly shifting away from traditional financial advisors and turning toward artificial intelligence to manage their money. What once sounded futuristic is now becoming normal. AI-powered platforms are building retirement portfolios, optimizing tax strategies, monitoring market risk, and even adjusting investment plans in real time, all without expensive advisory fees or human bias. For decades, financial advisors were seen as essential guides for building wealth, planning for retirement, and navigating market uncertainty. But now, a powerful question is emerging. If artificial intelligence can do the same job faster, cheaper, and sometimes even better, what happens to the traditional financial advisor? To understand why this shift is happening, you have to look at how Americans manage money today. The financial world has become more complicated than ever. People are juggling 401k accounts, Roth IRAs, taxable brokerage accounts, student debt, rising mortgage rates, inflation, and constant market volatility. At the same time, trust in traditional financial institutions has been declining. Many investors are frustrated with paying 1% or more in annual advisory fees, especially when those fees can quietly consume tens of thousands of dollars over a lifetime. For younger generations, especially millennials and Gen Z, paying a human advisor for something technology can automate feels outdated. They've grown up using apps to order food, hail rides, and manage banking. So naturally, they expect wealth management to work the same way. That's exactly where AI is stepping in. Modern financial AI tools are doing far more than simple budgeting. Today's platforms can analyze spending habits, evaluate risk tolerance, optimize asset allocation, and automatically rebalance portfolios based on changing market conditions. Unlike a human advisor who might review your investments once every quarter, AI can monitor your portfolio every second. If inflation data changes, if the Federal Reserve adjusts interest rates, or if market volatility spikes, these systems can react immediately. They process enormous amounts of financial data in real time, something no individual advisor can realistically match. One of the biggest reasons Americans are embracing AI financial tools is cost. Traditional financial advisors often charge between 1 and 2% of assets under management. That may sound small, but on a $500,000 portfolio, that could mean paying $5,000 to $10,000 every year. AI-driven robo-advisors and financial platforms can often provide similar services for a fraction of that cost, sometimes charging as little as 0.25% or even offering free automated planning tools. Over decades, those savings can dramatically increase long-term wealth through compounding. Another major advantage is personalization. Traditional advisors rely on conversations and questionnaires to understand client goals, but AI can continuously learn from financial behavior. It can detect spending patterns, identify tax-saving opportunities, recommend debt payoff strategies, and even forecast future cash flow needs. Imagine an AI system that notices your credit card utilization increasing, predicts a potential FICO score drop, and recommends immediate adjustments before it impacts your mortgage eligibility. Or a platform that automatically identifies IRS tax loss harvesting opportunities during a market downturn. This kind of proactive financial intelligence is becoming one of AI's most powerful advantages. There's also the issue of emotional decision-making. Human investors often panic during market crashes, and unfortunately, even advisors can be influenced by personal bias or outdated strategies. AI doesn't feel fear when the stock market drops. It doesn't chase hype stocks or overreact to headlines. It follows data, probability, and programmed discipline. During times of economic uncertainty, that objectivity can be incredibly valuable. For many investors, removing emotion from financial planning is exactly what helps them stay invested and build wealth over time. But this doesn't mean human financial advisors are disappearing overnight. In fact, many are adapting by integrating AI into their own practices. Complex financial situations such as estate planning, business succession, and emotional retirement decisions still benefit from human judgment and personal trust. The future may not be AI versus advisors. It may be advisors who use AI versus those who don't. The professionals who survive this transformation will likely be the ones who combine human empathy with machine intelligence. America is entering a new financial era, one where wealth management is becoming smarter, faster, and more accessible to everyday investors. Artificial in